Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time March 2023. You can probably hear it on my voice. I had a little bit of a cold, but I'm excited because I have some interesting data for you to share. March is always great because we start seeing data for the current year. And so I want to take a look at that today. People always asking me, is it true that people are really paying over asking price? So for the first time this year, I can show you the data. I can show you actual deals and how much people have paid over or under asking price if they were able to negotiate. We're also going to take a look at the impact of the Silicon Valley Bank collapse and the impact that had on the national and on the local real estate market. You might be surprised how these things all work together. And then we're also going to take a look at the question, is 2023 a good year to buy a home? There are a lot of factors that are making it not very attractive to think about buying a home, but I want to answer that question, at least give you some data and some thoughts on when you're contemplating that question on how to potentially answer that for yourself. So with that, let's get started with the latest numbers from MLS. I have here February 2023, so these are local numbers, and below you always have the benchmark year 2015. That was the last normal year we have seen in Milwaukee before the market started heating up here. So I used it as a reference. And inventory has been up a little bit. 2,295 units were on the market in February. That's up 24%, which sounds like quite a bit, but it's actually just a small number, and it's also the wrong kind of inventory, mostly on the higher price points and not exactly where we needed it. And you can still see, compared to February of 2015, we should have 11,000 units on the market right now, and 22 or 2,300 is really not a whole lot. But the big surprise is actually from accepted offers. So we are seeing a continuation of the trend. You've heard me last month talk about this, that the market is in a historic compression. We have not seen something like this in the Milwaukee area. Only 657 accepted offers. That is down 65% from last year. You can also see in 2015 comparison, we had about 1,700 accepted offers in February. So February is always, it's a short month, and also we're still in the tail end of the winter. So usually it's a lower volume market. In the summer, we're looking at 2,000, 3,000 accepted offers every month. But being down to 657, that shows an extraordinary compression in the market that has to do with where sellers currently are, and many of them are rate locked. They're looking at their very, very low mortgage rate and say, I don't want to give that up. I don't want to go on the market and then pay more for a bigger house, and on top of that also have to get into a higher mortgage rate. So that has to do something with it. But then, rates are also impacting buyers, of course. We're going to talk about rates more in just a second. Sold units, 1,054. That's also down 30%. Not much of a surprise here. Days on market velocity is picking up. And keep in mind that a good portion of that inventory that we see is just stuff that's not moving. So that is impacting that number as well. Good listings, good price, that are positioned well with great pictures and whatnot, are usually selling on the first weekend. And so when you break it down, overall data 16 days, but practically speaking, the good stuff is going on the first weekend, and that is very, very fast. And I'm not expecting the velocity in the market to slow down anytime soon. What's happening with prices? So this might be a surprise if you're following national news, evening news. You hear that all over the country, the real estate market is kind of softening because of the higher rates. 2023 seems to be kind of a year of consolidation after the 2 years, with almost 3 years of craziness that we had going on here. But in that context, Milwaukee is really an exception, and that trend continues to carry out here. So you can see 275,000 was the median price in February, and that is up 14.58% over last year. So we are seeing higher increases in prices in percent this year than we actually have seen last year. We were, if you remember, we finished last year with around 8% price increase 2022 over 2021. So we're actually accelerating because Milwaukee is really behaving very differently from the rest of the country. That has to do with inventory. Also another topic that I will cover in a few minutes. But let's stick with prices first. And what I want to show you is actual data from listings that have sold this year. So these are actual deals from the Milwaukee area. And you can see that a lot of them are actually selling still over asking price. And the way this chart works here, you have the zero line here in the middle. So everything that is on that line sold for just list price, everything that's sold up here, and there's some outliers that have cut off that were just crazy high, but that's not meaningful data. So everything up here that is over asking, and then everything down here, people were able to negotiate a discount. And here you have price points: 200, 300, 400, 500, 600, all the way to $700,000. And what is interesting, you can see the concentration here in volume. So of course, Milwaukee market, most of the volume is below $500,000. And when you would express that in percentage of the list price, you can see a lot of these deals went for 5 to 10% over asking price. As you're going up in price, you can see that offers are actually not quite that aggressive on the higher price points. There's some outliers. Here you have one that was 90,000, almost 100,000 over asking. But generally speaking, you're not that much high over asking, and expressed in a percentage, that is also a much smaller percentage over list price. And then you can see, all across, of course, not everything is selling over asking, especially stuff that is sitting on the market for a month or two. They are still coming in 10,000, 20,000 below asking price. That basically doesn't matter, and which price range you are, that behaves pretty much the same. Now the next chart is interesting because this shows the same data a little bit differently. So it's again how much over and how much under, but here you have on this axis days on market. So we're measuring on MLS how many days it takes before a listing goes under contract. And everything that you have here is basically listings that are selling on the first weekend. And you can see that if it's going quickly, multiple offers, usually we see between 5 and 15 offers. We see this both on the buyer side. We represent a lot of buyers, but we're also seeing it on the listings, how they are coming in. And a lot of them are 20, 30, 50,000 is kind of the cutoff here. Some people go 55, which is smart, a little over. But you see that concentration. As soon as you are more than 7 days on the market, there is a really hard cutoff. So it really changes the dynamic. And you can still see there's still stuff that goes over list price, but a lot of them will go under. And the longer they're on the market, the more the likelihood is that the seller is going to agree to a discount. So this is a trend that we have been seeing last year. This is basically a continuation. A lot of people have expected that this year prices are softening in Milwaukee. Like I said, this is not happening. And here you have the data. These are actual deals, listings in the Milwaukee area that have sold and closed this year in 2023. So this is as current of a data as we can possibly look at. All right, next let's take a look at the macroeconomic environment. So when you look at the big picture, there's still a lot of good things going on that would really have a positive impact on the housing market. Consumer spending is very good. Consumer confidence is good. The job market is more than robust still, despite recession concerns that we have, despite the situation that we have in the Ukraine, etc. Things are moving generally in a positive direction. Also inflation. We have here the latest numbers from the consumer price index that came out last week at 6.0%. So we are down another little step from the 6.4 we had the previous month. So that's moving in the right direction. We are still not where the Fed wants to be, with 2 to 3% inflation, so we're still quite a bit elevated. And as you know, inflation is, you really have to think about this as a devaluation of the dollar. So you have to bring at the moment 6% more dollars to buy the same goods and services that you bought a year ago with fewer dollars. So that's certainly also impacting the real estate market, because real estate is a hard asset and usually performs well during times of high inflation. So the Fed is going to make a decision next week on what they're going to do with the funds rate. And before Silicon Valley Bank SVB happened, a lot of analysts were expecting that rates would be going up by another 0.5%. It looks like that a lot of people lowered their expectation. that the Fed will be acting more cautious and maybe only increasing it a quarter point. Whatever the Fed decides, it will going to impact the markets, impact the 10-year Treasury, which will impact the mortgage rates, and that in turn will impact the housing market that we have in Milwaukee. How is this working? So when you look at mortgage rates, there is, and this is not rocket science, that everybody can see this, mortgage rates are impacting the market for buyers, of course, because higher rates means that you have to agree to a higher monthly payment, which reduces your budget if you want to buy a house, or you have to accept a higher payment. So when you look into the psychology, everything over 7 is really bad news, because that is just a number that a lot of buyers don't like. If you go below 6.5, below 6, things start to look a lot better and a lot more palatable to a lot of people. And by the way, this also impacts sellers. So we have a term for this. It is called rate locked. So a lot of sellers are currently rate locked. They are living in a house that they frankly would like to sell, maybe buy a bigger one, but that means agreeing to a higher purchase price and doing so on a mortgage rate that is maybe twice of what they currently have on their existing home. So that is really de-incentivizing sellers for putting houses on the market, and that is part of the inventory problem that we have. We'll talk about that again in a second. So the curve that you see here, the white line, that is how mortgage rates have been behaving over the last few weeks, and you can see they have trended sharply down. That is not unexpected. The reason why they trended sharply down was unexpected, because that is exactly Silicon Valley Bank. Let's take a look at how the correlation looks like. So this is the last 50 years of the 10-year Treasury yield. That is the blue curve. So that is a very conservative government bond that investors like to park their money in. That is very, very safe. And there is no hard correlation to mortgage rates, but the market kind of makes for that correlation. And if you compare the two curves, the green one is 30-year fixed mortgages. You can see that over the last 50 years, they really follow each other to a T, and the average spread between the two of them is 1.7. So keep that number 1.7 in mind for a moment, because that is going to be very important. When you look at what's happening over the last 3 months, basically, you can see that we had a much, much higher spread. We had a 2.7 spread. And so the market is making you pay a premium currently that has to do with everything that's going on in the economy. And as things are stabilizing, we're expecting that spread to come down to historically more normal levels of about 1.7. That is the reason why most of the analysts and bankers, when you look around, when you look on the internet, everybody who's professionally in this field is expecting that long term, in the next 1-2 years, rates have to come down, because that premium is just not normal and is expected to go away. Now, here's a chart of the Treasury bond, and I want to talk for a second about what was happening with the SVB collapse, because that's currently at everybody's mind. So you can see up here on the right, if you follow the blue line, when the collapse basically ran through the media, and then you can see very, very quickly the Treasury came down. On the 17th, we had a Treasury rate of 3.41%. So that was a very sharp, very, very quick decline. And if you add the average spread that we should usually see, that would be our 1.72, we should see mortgage rates right now at about 5.13. But that's not happening. The actual mortgage rate as of yesterday, if you have really good credit, was 6.7%. So there's still a lot of premium in there, and we will very keenly follow this over the next weeks, how this is going to continue to develop, because as you've seen, this has a huge impact on the market. So mortgage rates are one big factor that is impacting the marketplace. The other one, and maybe even bigger challenge, is inventory. So I've spoken quite a bit here on this channel in the previous months about where the demand is coming from. And if you haven't seen that, just in a nutshell, the demand is coming from a demographic shift. We have the generation of the millennials that for the longest time have said, we're not going to buy a house, we're just going to rent. That's much more flexible, and that's how we want to do it. But the oldest millennials are now turning 39, 40 years old. They're getting married, they're having kids, and they're basically following the same pattern as previous generations, just a little bit later. They're just sick and tired of renting, and they want to buy their first house. And when you look at the numbers, it's very easy to understand why we are so overwhelmed with buyer demand here in Milwaukee. We have about 1.6 million people living here in the metro area. About 350,000 of them are millennials. And not all of them are trying to buy a house at the same time, thank God, but a portion of them is in the market buying a house. And when you look at 350,000 millennials versus a market that in February has sold 650 accepted offers, you can see how that demand can easily overwhelm the supply. So that brings me to the inventory issue. And I want to take a look at that. Let's zoom out maybe and take a look at the bigger picture. So this is US national inventory. We're usually around 1.5 million units. You can see strong seasonality, lowest inventory always in January, and then it starts ramping up traditionally to the summer market. This is when you see the highest inventory. And quite frankly, this is what we're banking on that's going to happen this year as well. What you hear a lot in the news is that inventory is up and therefore markets are softening. And what they're referring to is the difference between last year January and this year January and February. So you can see this is moving in the up direction. And this is where we see on the national level a little bit more inventory. And there's a lot of markets that are behaving much, much differently than Milwaukee at the moment. Here, this red line is when we went the first time into COVID lockdown. And that COVID lockdown had really had an impact on the housing market because it changed a lot how people were thinking about having their own home and being able to reside inside of their house in privacy and having space and not being confined to a small apartment. So that has really started the whole run. But the initial root cause actually goes back quite a bit further. COVID has just amplified or really put the spotlight on the housing issue. Where the whole thing is coming from is that for 14 years in a row, we have built way below average. So you can see here, the black line is kind of average US house production every year. And then after the crash in 2008, we have decided to stop building new houses, which was the correct thing at the time. But then we have scaled it back for 14 consecutive years. We remained below average. And that, of course, is not really helping. This is where fundamentally the inventory shortage is coming from. So you can set market psychology aside. You can just say, okay, this is what buyers and sellers want at the moment. The underlying issue is that we just have more people than roofs. And this chart here shows you the reason why that is happening. We have just underproduced for 14 straight years. And when you ask banks on why this is happening and how much units we are short, how many houses we need to basically build, and that is going to take a while. So just for chicks and giggles, I did some simple math here. I'm going with Freddie Mac in the middle. They say we're short about 3.8 million. So you divide it by 50 states, you end up with about on average 76,000 units that we are short. So we would need an extra overproduction of 76,000 units, and what we're currently cranking out is about 11,711. You can see that we have not gone back. Our production has increased over the last years, but we have not gone back to where we used to be, let alone started filling that gap that we have opened up over the last 14 years. So this is fundamentally where the shortage is coming from. And the other problem with that is, from a price point of view, we are building the wrong kind of inventory. When you drive around here in the Milwaukee area, you look at new construction, there's quite a bit going on west in Waukesha County, Menominee Falls. We're building quite a bit here in Ozaki. Also on the south side, Franklin area, you see some new subdivisions. The main thing is they're all way too expensive. Most of them are around 525 to about 650, I would say. And that is not within reach for a first-time homebuyer, especially now with the higher interest rates. And that's the reason why for the foreseeable future in Milwaukee, we are going to be in this situation because those things are not changing. The demand from the buyer side is not going to go away. Millennials are not going to change their mind. And we're also not miraculously finding 76,000 houses somewhere in Wisconsin that are currently not there. So it will be a while before we have that addressed. So big question becomes, should I buy a house right now? Should I buy a house in 2023? It's arguably a really tough market. It's not easy to buy a house right now. The question is it still worth doing it? And here's a chart that I want to show you. This is rent growth since 1988. And you can see that's been quite a journey. Rents have been nothing but going up. If you choose renting as a long-term solution, you're basically subjecting yourselves to the annual increases. So even if you don't decide to get a bigger unit because your family is growing, if you stay in the same size unit, typically your rent is going up every year. And this is what buying a home actually disrupts, because when you buy a home, you are locking in your monthly payment. You're locking it in, you have predictability. And housing is for typically a family the single largest expense. So that is subjected currently to growth every year. If you're renting and if you're buying a house, you're locking that in. Here's a little look back on how home prices have changed since 1991. The national average is about 290%. Wisconsin is right around there, about 284%. We're typically, I guess, lacking a little bit behind the national average. And we have some high flyer states, of course, especially as of late, Texas, Florida, the southern states, Tennessee, they have gone up a lot. And of course, the western and the mountain states, where a lot of Californians have moved here into these states and have really driven up prices here. This is why you're seeing these large increases. But when you're buying a house, you really should be doing this with a long-term perspective. It is not the stock market perspective where you say, if I wait another week, maybe I get it a little cheaper. Really the right mindset is, what is the right thing for my family to do for the next 10 years, for the next 20 years? And when you take that long-term perspective and you consider where rent is going and where home values are going, then you get a different picture. So these are 200 experts that are getting surveyed on a regular basis. And this is the latest data from Q4 2022. What are they expecting? Those are economists. Those are specialists from analysts from banks like Goldman Sachs, from Morgan Stanley. And they're being surveyed. And what they're saying is that in 2023, on a national level, we're going to see home prices to go down. But beyond 2023, we're going to see home prices starting to appreciate. And that has to do with the inventory situation that you've seen before. So that is the long-term prediction here. I think Milwaukee is going to behave a little bit differently. You can see it already in the numbers. Our prices are up almost 15% in February. That trend is going to continue throughout the year unless we see something majorly happening and changing. Which is currently not on the radar. This is going to continue here. And that fits into that national picture that I have, because I think 2023 is a year of consolidation. The markets that have gone up over the last 2-3 years at insane paces, where home values went up 30-40%, and then the next year another 30-40%, which is completely nuts and not sustainable. Those markets are consolidating now. Their inventory is building up and home prices are coming down a little bit. That's a healthy thing. At the same time, we're seeing the markets that have underperformed compared to the national average in the last years, we are seeing them going up. And if you travel a little bit, it's very easy to see that Milwaukee is not a below average city, but we are priced here in Milwaukee from a real estate point of view quite a bit below national average. And I think 2023 is a little bit of a year of reconciliation, of equalizing, and we see the top markets coming down a little bit, and we see the lower priced markets coming up a little bit, and everything is going to consolidate a little bit more around the national average. So in conclusion, what can we expect for the next weeks and months here in the Milwaukee area? First of all, we're going to remain in a competitive market situation. A lot of listings are going to sell substantially over list price with multiple offers. Not all of them by all means, but a lot of them will be. And the trick is going to be to determine, to know which ones are going over and on which ones you can negotiate a little bit. But overall, I think from a price point of view, we're going to outperform the national averages. Spring inventory is going to continue to rise. I don't have hard data for you, but anecdotally, I can tell you already that in the last week or so, we have seen more and more listings coming on the market, hitting MLS. There's more listings in delayed on MLS. I talked to other agents. And I also am working on a few listings that are going to go live very soon. Super excited about this, to helping out with the inventory situation a little bit. But overall, I think the increase in inventory that we're going to see this year might be a little bit slower than we have seen it in previous years. Nonetheless, that means that we can spread buyer attention over more listings, so that helps with more choices and the competitiveness coming down maybe just a little bit. From a buyer point of view, mortgage rates are going to continue the major factor, and that means that a lot of buyers are going to remain on the sidelines. They're deterred by the currently high mortgage rates. They're waiting for rates to become lower. And my advice here would be, if you're financially prepared, if you can swing it conservatively, take advantage of this and get a house under contract now, and don't wait for lower rates. Rather, get the house now, and then when rates are lower, if and when they're lower, then refinance and take advantage of that when it comes to it. But lock in your housing expenses now as you can. From a seller point of view, trading up is easier than trading down, because higher priced homes tend to be a little bit less competitive, and you may have more equity in your house than you think. Your house might be worth currently more than you think. So what can you do next? If you have plans for this year but not sure how, then let's talk. You can just go on my website and schedule a phone call or a Zoom call with me. You have access to my calendar and can pick a free appointment that works for your schedule and book it right there on my website, On Point RG. You have the website address here on the lower left corner of the screen, so you can see my calendar and book it right there, and we can just have a chat and see what your personal situation is and how we can play your cards the best way this year or even next year in this marketplace. If you want to stay on the pulse, if you're not ready to do anything yet, but you want to keep monitoring the market, I have also something for you. We can sign you up for MLS access. You can also do that on my website. We just need your email address, a little bit information of what you're looking for, and we're happy to set you up with a free MLS login so you can search like a pro. And of course, if you're wondering and you're not sure how much is my house really worth, that's usually the first question you have to answer. When you start in your mind contemplating about maybe potentially future plans, the first data point you need certainty on is, how much is my house worth? And of course, we can help with that with no obligations. Just let me know, leave a message on my website, and I'm certainly happy to help out with that. In general, I'm very curious what's on your mind. What do you think about the information that I've provided you? What concerns you? What would you like me to talk about next month in the Milwaukee Market Update? Put some comments below. I always love hearing from you, answering your questions. And that's all I had for you today. Thank you very much for watching. I'll see you next month.